Hello, ladies and gentlemen. Welcome to our Thursday Zoom session. And we are live in Zoom. Like when you want to join us in Zoom, be like Paul. We have a special guest today, and I think you guys will absolutely freaking love it. He's a good friend of mine. He's one of the most awesome human beings I know, and like one of the best investors I know. And he's a CPA on top of that, too. He's the Investor CPA. He deals with Texas. He can tell you the IRS code up and down. Larry Pendleton, second time with us. How are you today, my friend?
Hey, Robin, appreciate it. How you doing, sir?
I'm really well, really well. Pretty busy these days, and I think it's the third or fourth call we have this week, and I'm super excited because, like everybody's always about like Texas and land investing, and everybody's struggling with that. So I appreciate you for hopping on and coming on. And I know that you will talk about today the big, beautiful bill and what impact that has on investors and what they can do to make more profit and more money and all of that. And I'm super excited about that. Um, so let's get rock and rolling, man. I know you have something prepared, and I'm super excited with that. What you want to do, probably, you want to take a piece of paper and you want to take a pencil and just like listen to the wisdom of this man, right?
No, grateful opportunity. Let me share my screen real quick. Um,
Here we
yeah,
are. We can see your screen. Great.
awesome. Yeah, grateful for the opportunity to speak tonight. Good evening, everyone. Larry Pendleton, the Investor CPA, based out of North Virginia. So grateful to talk about the big beautiful bill that came out in July 4th. So still a lot of information that's coming out, but so hopefully I'll be able to add some value to the community here and just kind of help people leverage these expansion of new tax law or expansion of existing tax laws as well as the new tax law that this bill is provided. Um, quick introduction. Like I said, Larry Pendleton. I'm based out of Norfolk. My dubbed the Investor CPA, but my tax business is PC Financial Services, as well as my real estate business is CP Realty, as well as Pillar Developments. So me and my partners, we do new construction. We buy and hold notes. We buy land as well. Um, as well as other type of investment. We kind of run the different gamut of real estate over the past decade. So grateful to kind of share my knowledge in that space. Because for me, it's just really kind of combining the real estate and the taxes to really serve my mission, which is to help people build passive income and save on taxes. I think those two things combined helps people kind of live their purpose when they hit their financial freedom number and don't have to worry about Uncle Sam taking taking too much of a chunk out of out of their money. And the way I approach this is really through the Robert Kiyosaki cash flow quadrant with the employee, self-employed, big business, and investor quadrants, but the tax aspect of it is really understanding that the left side is paying the most in taxes. So it's like, how do you really start to work our way? Because most of us kind of start off in that employee uh, arena, get into being self-employed, but how do you get to that right side of the quadrant? Of course, being in that bottom right of the quadrant where like you have a significant less amount of your money tax as well. So and that's what this bill actually kind of goes into. So I don't want to talk too long on a Thursday night and bore people to sleep about taxes, but that's what we'll kind of cover tonight, just to get everyone familiar with what to really take back to your tax advisor as you do your tax planning for the rest of 2025. I would say like none of the tax changes it doesn't retroactively apply to 2024. So I know we're dealing with extensions right now as we approach the 10/15 deadline. Just passed the 9/15 deadline earlier this week. So, but just know you got opportunities this last quarter of the year to kind of start implementing some strategies that work for you. But as always, there's a disclaimer. It's for informational purposes only. I'm not your advisor. Please take everything I say, do your own due diligence, talk to your your own attorneys, your CPAs, your enrolled agents, and just kind of make sure that what's being said applies to you. Um, we cool with that? Everyone good?
Everyone good. Let's do it.
Awesome, awesome. So people that know me, I'm real big on mindset. So when you're talking about saving on taxes and how this bill is really structured, there's five things you really need to keep in mind as your base understanding. One, the tax code is made for business owners and investors. I really don't care about your political affiliation. I don't really care about how you feel about politics. Like this has always been before any of us has been around. So the lack of understanding of how that's how the base of the game is set up, there's like you're already behind the eight ball if you're thinking that employees should be getting more tax deductions. The system doesn't work that way. They want people to run businesses and invest into oil and gas and real estate to help stimulate the economy and keep the system rolling. Employees they keep their companies rolling, so it's on their employer to benefit them with paychecks. But they're now are but the country as a whole, the government really wants individuals to serve the country and the masses, and get the tax benefits that way. Um, any tax strategy that anyone tries to sell you, any tax strategies that's involved in this presentation, it will cost you time and money. There's not just, hey, if I just look in this direction, I get a tax deduction. Like, nope, you're gonna have to spend some money and it's gonna take some time and effort. So just kind of know what your situation is personally and take a holistic view of if that strategy is actually worth it, not just saving on taxes because you do not want the tax tail wagging the dog. You can easily try to get, I've seen people buy vehicles, whatever, for business purposes, but then they still got to pay the insurance, they still got to pay the taxes, they still got to pay for maintenance, and it becomes more of a burden than and that tax savings is long gone because typically it's just a 1 year play and you can get some write-offs along the way. But just know that like it's you don't want that to be the driving force. It's going to have a negative impact on you financially overall. um, and as I mentioned before, tax planning is all year round. Even for this fourth quarter, we meet with clients prepping for 2025 tax filings. Um, 2024 is already done. Like we're already already kind of doing the filings there. There's not many strategies we can put in place now, but with these new tax laws in place, now we can start to kind of implement new strategies going forward now. And last but not least, I'm not sure who everyone uses for their tax advisory, but just know that CPAs, enrolled agents, accountants, tax advisors, we're not all built the same. So whatever your investment model is, especially if you're in the land space or in the real estate space, make sure that your advisor is well versed into that, or whoever you're trying to look for and hire are well versed in that, so that you can feel more comfortable. They can explain to you so that you can make an informed decision of why this strategy does or does not work for you. So hopefully that makes sense of just kind of laying that groundwork and understanding of how the tax code um, really operates and as we kind of get into the presentation, you'll start to kind of see where this kind of all flows from that standpoint there. Everybody still with me? Still awake? Cool.
Still awake is the good thing, right? I think it's like for us, like normal living human beings, like Texas is such like an abstract topic that we're just like, okay, like what is he talking about? Like tax planning all year round. The classical investor is probably like me sometimes, right? Like, oh yeah, taxes I do. Let me take care of that right now. But I think, yeah, in the end, like especially when you make money, taxes are like that. What you need to plan ahead, right? This is probably the message you're saying here, right? And telling us, and I can just tell it from my own experience. It's always better to be prepared and have a strategy in place and think about that ahead than reacting in the moment where shit gets you, right? Because then oftentimes like shit hits the fan too. So right. So I think that's my takeaway from that. And I also like the last thing you said, right? Like, so my grandpa always said, Robin, there's two super important people in your life beside of your wife or husband, right? It's your doctor and it's your CPA. And you should choose your doctor wisely, right? That he doesn't do a bunch of crap with you. So your CPA, you should choose that person wisely too, because we just had a family situation here where I connected somebody out of my family with Larry because like the CPA on this side messed it up and it was like a six-figure probably failure that was done there. So you really want to see like when you choose a CPA, who do you work with, right? You want to have somebody that in a sense, especially the investment leg, right? Like because there's even in real estate investing, like we as land flippers, oftentimes we're not really investors, we're more like dealers, right? Like how do you structure that? How do you do that? How do you build your company? How do you when you have an LLC? How do you tax that? You tax that as an LLC or like as an S corp or whatever. There's massive like things you should prepare for, and probably like if you don't have anybody you feel comfortable with, right, with, you want to schedule a call with this guy because he can tell you everything about it, right? Like, and that's what it really is because when people think about taxes, you probably think about bookkeeping, but it's not bookkeeping. Like doing your taxes is a complete different animal. The bookkeeper just delivers the data to a really good CPA that he can build the right strategy for you that you can save a lot of money while you make money, right? This is what it is. And sorry, I didn't want to interrupt you, Larry. I didn't want to steal the show. I just wanted to give some my takes here, right?
Oh, no, all good. Appreciate your insight in that. Is all solid stuff there. So, but let's get rolling. So, what people need to understand about the 2025 tax changes is that um it's helping out because during Trump's first term, and he had the 2017 tax changes. A lot of that stuff was starting to um, um, dissolve or kind of expire along the way. So what these new tax changes now are doing is kind of help extending that because the country was about to see a large increase in taxes across the board for everybody, no matter what tax bracket you fall into. So what it ended up doing was maintain the tax brackets for the 2017 from the 2017 Tax Cuts and Jobs Act. Before that, before the TCJA, I see you can see it was like 10, 15, 25. The terms were kind of all set and like set before that. But it lowered it to really in that mid range to like 12, 22, 24, 32. So without these tax changes, you would have seen really basically a 3% plus increase in the tax brackets overall. So people are I was gonna say it's kind of safer now, just knowing that they're not going to be seeing like jumping into huger tax brackets, especially as you're making more money in your business. So there's a huge benefit for that to kind of keep everything in place to the kind of the ground level of okay, we the code itself will kind of help you save on taxes without it going back to what it was before 2017. And just kind of give you a bit of a example here of how the brackets kind of fall. Um, and I tell people where it's like, okay, here's you're in certain tax brackets, but really how your tax is more so an effective tax rate or average of all the tax brackets that you fall into. So as your income grows, the lower part of it is taxed at a lower rate, and then I tell people if you're a dollar into the 24% tax bracket, not all your income is taxed at 24%, just that $1. Everything else then taxed at 10 to 22%. So as you're talking with your advisor, and that's how we can tell what your potential tax liability will be before the end of the year, is because we can then take whatever estimates that you have for your business numbers as well as your W-2 year-to-date numbers and project out that the last part of the year. I think there's a little typo in here as well, so I apologize for that.
Oh, I wanted to say that anybody ever made you aware where the typo here is? This is how you can probably realize if people fell asleep or not, right?
Yeah, I mean, since July 4th, it's kind of been the world tour, kind of doing this
Yeah.
communication, and like man, I should go back. I just never had the opportunity to go back and change the correction or make the correction. But overall, like I said, yeah, it doesn't drop back down to 48,000. It's still 448, 476, and up to kind of go from there. So like I said, I just want to kind of give basically kind of a high level view of like how your income kind of flows through the different tax brackets, and then how um we're this the big beautiful bill is helping kind of keeping us kind of status quo at this moment now, and not seeing that increased hike, and is extended permanently. There's no real deadlines, like no real phase out period like it was with 2017. So really is really based on Congress now, future Congress, if they want to change it down the road. So just know that we got that pretty safe. Um, Questions on the brackets at all? Clear as mud. Perfect.
I think that's pretty good, right?
Secondly, I want to cover is the qualified business income deduction. Once again, this was uh, another potential phase out from the 2017 tax changes. So what it really is that um, when the corporate tax rate went from 28% to 21%, um, most small businesses are not going to be C corps. C corps are really for venture capitalists, those that are going to go public, not really holding like tangible assets like land. Um, so most like, especially if you're buying land, you should not be having your properties in any type of corporate, whether C or S corp. You're most likely going to have in an LLC or in a trust. But the activists, the lobbyists for small businesses, like, hey, like this 21% corporate tax rate is great for the big boys. What about the small businesses? So that's where you had the 20, this basically this QBI or 199A deduction, which basically is a 20% haircut off of your business, if you're showing profit on your net income of your business. Uh, excuse me, there are income phase outs with it. And but I wanted to bring this up as this renewal from the tax code, because I've seen this missed a lot in a lot of tax returns, when people are making good money in their business, but they're not having, or they don't have any losses to offset it, but they're not but the whoever's preparing a tax return isn't factoring in that QBI deduction for whatever reason, or not really explaining it to them. So it's very, very important, to go back if you want to amend, especially if you're looking into your 2024 tax return, to take a look into that to make sure you that's factored in if you qualify, and have your person explain to you why you don't qualify if you don't see that number, and make sure that's in place going forward, because it has been extended with this, and it was set to phase out as well. So we're fortunately kind of get that back on the plate, for business owners. Now, what businesses qualify? So some, like, basically you're selling goods and services, some rental activity, and some lending activities. Mainly was proven like the rental and the lending side, like how actively are you involved? And typically that's an hours requirement there. So as long as you're like tracking your hours and kind of prove like, hey, you are actively involved in that business, you can take advantage of that deduction there. And typically, how you're proving it is with time logs, kind of showing, and not just like, hey, I spent 4 hours. Like a little more, a little more details in place to kind of check that. Now, if you're um, just a passive investor and just kind of offloading it to someone else to do the work for you, you're not really going to see that benefit of it there. So opportunities where it's like, hey, if you put the extra time into it, there is the benefit, but once again, does it fit into your lifestyle, the time that you have, so forth and so forth. Unfortunately, it doesn't apply to W-2 income. Your W-2 income does impact, if you do qualify for it, because the income phase outs, but you can't use that QBI deduction to offset your W2 income. And unfortunately for businesses, like being a tax advisor and a or attorney, specialized services, trader businesses don't qualify for deduction as well. So most of you all on this call, if you're actively lending or you're active in real estate, you do have the opportunity to leverage this deduction, and nothing wrong about getting a 20% haircut off the net income of your business, especially if you don't have any losses to help offset that. And
So
last,
you as a tax advisor don't get any benefits from that?
no, I don't. So it's really more so in my real estate business is how I can benefit from it. Um, yeah.
They don't want you to get too creative around that, right?
Yeah, exactly. Um, so for those who kind of wondering like where you see is on your tax return, is one to kind of highlight. You look at the bottom of page one of your 1040. You'll see is that's the form that's referencing 899 899.5A, like that's your QBI deduction, or 199A. It's all interchangeable at that point. But it's one to kind of share that from there. Questions on the QBI deduction?
Guys, he will not charge you. If you have any question around your taxes, right? He can answer them live right now, right?
Yeah, open. Yeah, I'm always happy to be interrupted. So I like the
Yeah.
dialogue instead of just talking in the screen and going over these slides. So happy to address any question anybody has. Um, Third on the list I wanted to cover, some people think it should be number one, is the 100% bonus appreciation. I've seen a lot of clients who they basically really voted for Trump because this was promised to be brought back, and him in Congress did at this point. So for those who are in buying rental properties, buying commercial buildings, or buying equipment or vehicles for your business back between 2017 and 2022, you was able in position to write off significant portion of those assets with 100% bonus, especially in the real estate space. For vehicles and equipment, you was able to write off the full thing, but for properties, commercial or residential property, people were seeing really, I would say 20 to 30%, sometimes even 40% of the purchase price being deducted there. But since 2022, it was a sunset, 20% sunset period. So it was 80% 2023, 60% 2024, and about to be to 2026, it was going to be completely phased out. A lot of us in the tax advisory industry, we thought that it would be readdressed. It was a possibility it was going to be brought back last year under the Biden administration, but it didn't pass through Senate. But it was able to get through to this year during Trump's administration here. So so what we're talking about, we're basically saying that any assets that depreciates less than 20 years, you're able to write that off fully. Um, and and how people were doing that was with cost segregation studies for their rental properties, or they, like I said, when people were buying buying G wagons and a whole bunch of fancy vehicles or large vehicles of 6,000 pounds or more, and combining that with Section 179. Um, and seeing huge benefits, especially for people who couldn't claim real estate professional status because they had a full-time job, or they may have been investing into land, but they really didn't, because you can't depreciate land. So you all as land investors, you're still having to dabble into rental real estate, actual buildings and brick and mortar in order to get the tax benefits. But as I tell people, you use your main biz to make your money. You use residential commercial real estate to save on taxes and build wealth, because you is another passive income stream for you there. Um, we talked about the business equipment. So a lot of times how people are getting into oil and gas investing now and getting the what's called a working interest, where you can be a passive investor into an oil and gas fund, and you're able to get a deduction because what they're doing is buying all the equipment and getting the 100% bonus depreciation in Section 179, and they can pass that on to their investors who aren't actively involved. So you don't got to worry about being a professional in oil and gas. So it's just another area where if you can find a vetted operator, which is really the toughest part, is finding a vetted operator in the oil and gas space, um, and then trusting that, hey, I'm gonna get a deduction, but they're a vetted organization. I'm gonna get my money. I'm not gonna lose my money, or it's minimal risk, I should say, of losing my money by investing in them, so I can get the cash on the back end while getting the tax deductions year one. And what they're doing is just writing off all the equipment in year one to create those losses there. With real estate, now you're gonna start hearing about more cost segregation companies. I'm not gonna name any, but they're all. I talked to many of them. All of them do good work. Just make sure that the fees associated with getting a cost segregation study, you can actually use those losses and to create the tax savings. And that's when you really want to work with your advisor because the cost seg company is going to give you an estimate based off the highest tax bracket, and you may not be up there. As I said before, you're not based on a 35% tax bracket. What's your effective tax rate? It may just be 20%. So I'm not saying that, well, I guess I am saying that they inflate their tax saving numbers, but the deductions are real. But you want to make sure that you're able to use those deductions instead of paying two, three, four, five plus thousands of dollars for this report and it's not giving you any year one benefit that you're looking for. Not saying that you can't use it, you're just not able to use it year one. Use to offset other passive income or use it in future years. But just keep that in mind when you start to hear more and more people talking about cost segregation studies. Now, unfortunately, I'm in Virginia, so I put VA there. But there's many other states that don't recognize bonus appreciation. So like New Jersey, California, New York, um, and some other states as well. So just be mindful of you may see a huge reduction in your federal tax liability if you are able to use those losses, but you're not going to see that same reduction on your state tax return if you're in a state that you file state income taxes because they haven't recognized it for whatever reason at that point. So just kind of just understand that you may have some limitations with that if you're not being mindful of what your state tax laws are, or if your advisor isn't aware of what your state tax laws are when it comes to bonus appreciation there. Question on any of this stuff here? Cool.
Here we have one. Jim, go ahead. Oh, now the tough questions come. You need to be aware, Larry.
It's not a tough question at all. It's not really on what you've covered so far. I mean, I don't have a lot of ways to take advantage of some of the things you mentioned. And what I've done is I've set up a self-directed IRA, and I run my bigger sales through that. And I just let that build up for retirement. I do have some extra money set aside to do that. And it was really just something that I saw as a way to avoid paying taxes on a lot of the bigger deals that I was doing.
Now,
And
when you say sales, you talking about just kind of you lending out of your, or are you doing the sales out of your retirement account?
so what I do is I buy properties through my self-directed IRA and then just sell them, whatever accumulated profits stay in the self-directed IRA, and I just use that as a fund for properties as I move forward to buy and sell.
Okay. I mean, you may just want to be a bit cautious with that because you're generating what's considered ordinary income or active income out of your retirement account, and that could subject you to UBIT taxes. As I haven't really, I mean, there's ways to do it and not you get hit with that tax, and you probably, I'm not sure who you're working with. They're probably fine and helping guiding you along the way. Uh, just be cautious if you're selling properties and generating the ordinary income that could trigger that 37% UBIT tax.
Right. So I'm not taking anything out of the trust. Everything stays in the trust. I buy, and then when I sell, all the proceeds go back into the trust.
Is it trust or is it okay? I thought her retirement account at
It
IRA.
is, well, it's a self-directed
Yeah,
IRA
yeah.
that's
So it's not about you taking any money out. So you can keep the money in, but the fact that you created a so I can run a tax business out of my retirement account, not take any money out, but my retirement account is still going to be taxed with UBIT. So it's not you, Jim Lee, the individual being taxed, or me, Larry, being taxed out of my retirement account. It's the retirement account being hit with that UBIT tax because you generated income that's not allowed to be considered tax free within the retirement account.
But I thought that was the whole purpose of a self-directed IRA, that you could invest in other things besides stocks and bonds or whatever. Like
Yeah,
it's
you can. Yeah, you can be a private lender out of your self-directed IRA and grow it that way, or you can just buy and sell notes. Like say, but it's the type of activity where it's like hey, it's passive or it's portfolio from that standpoint there. Where it's like, hey, I'm just lending out of it, or I just got rental properties in there, so it's passive income, or I'm just generating interest income from these notes or from these land deals. But if I'm buying a property and then selling it 6 months later, that's not passive or portfolio. That's considered or non-passive or what's considered ordinary activity that could trigger the UBIT tax within it.
okay. Yeah, I
But
guess
so
I
you're
I guess
allowed
I
to.
need professional help.
Yeah, I'm gonna say yeah. I mean, like I say it's. Like I say, I'm then depending on who you're working with, especially because custodians also should be guiding people as well, because they know that's why people are setting up self-directed IRAs and so forth. So, like I say, as a without really knowing the situation, I just want to throw that caution um, uh, to that point there.
Yeah. Well, it sounds
I
like
think, Jim, what you want to do is you want to take your phone out and do this fancy QR code there with Larry and hop on a call with him. It's worth it. I
yeah,
can
yeah.
promise you
No,
that.
I was thinking the same thing, just to like I've kind of done this on my own based on some things that I read, and after talking to the custodian, it seemed like it was legit and I could do it, but maybe
Yeah, and like I say it's and Matt brought up a good point. Like I say, if it's because it's sometimes it's about volume, and so it's just hey, you just did a one, you just did one or two or three, but you're not doing a like 5+ in 1 year, and that would kind of help. Like, all right, this guy's actually running a business. But like I say, so there is the aspect of the volume. That's why I just want to just say just be cautious with it if depending on how many deals you're doing um in a year. Because you could be tipping that scale where it's like, hey, I just did one, but I'm not really active. I'm not really a dealer, or running a flipping business out of my retirement account. So Matt brought up a good point. It's just like I said, just being cautious of what deal number are you in um on September 18th. If you're already at 2 or 3, or you probably shouldn't be doing anymore, because you may tip the scale in a not favorable way for you.
yeah. Okay. Well, it sounds like I need some professional guidance on this one.
No worries, no worries. Like I said,
Larry, this is the point where you should drop your phone number and email address right here in the chat that people can schedule a call with you, right? That's what we want to do right now, okay?
yeah, I mean
You
the
know what?
QR codes.
I gonna do it. Do you use your cell phone number for this? Or shall I just drop a link? Like what do we do here?
Yeah, yeah. I'll drop my landing page in there so people can book a time with my team or with me, so that we can have further discussions from there.
Yeah, I'm looking for a new uh, tax professional anyway, so maybe we have something that we could do together.
Yeah, grateful for the opportunity. Always grateful to help out in situations like this. But like I said, you're probably fine. Like I said, it's just I always want to throw that caution out there just in case, but you may be good to go.
All right. I'd rather know for sure.
No
All
problem, no
right.
problem. Great stuff. Anything else before we move forward?
Did you get the messages that Matt sent here? Wait, what
Yeah,
was that?
that's what I was referring to earlier. That Matt made a good point of, like I say, it is there is a if you're just doing like I said 1, 2, or 3. If Jim is in that boat of like, hey, I just do a couple of these a year. I don't really be, I'm not Mr. Flip out of my IRA 1, 2 times a month. It's more 1, 2 times a year. He's probably fine. But like I said, it's just kind of knowing where that threshold is. Was like, all right, you may be pushing it if you're going to go try to go past 3, and now we're having to treat all the income associated with the flips as subject to the UBIT tax.
Yeah. Yeah. I think I'm hitting the limit.
Hey,
I think
doing
so
big
too.
things.
I think so too, Jim.
I don't do all my
Really?
deals through that, but enough.
Oh, no
Enough.
worries. All good.
All right. Thank you.
So I like my Big Mac analogy when it comes to talking about bonus appreciation. Um, Anybody want to sing it with me? Gene, are you in? I see you smiling, Gene. I think you know the song. Nope. She's gonna stay in mute. But
I don't know the song.
so when it comes to like depreciation itself, like when you buy that asset as a whole, the normal method is straight line. You take that purchase price, you back out the land value and depreciate over 27 and a half years or 39 years, depending on the type of property that you're running. But when you're getting that cost segregation report, like what it's doing is breaking up that property into multiple components because not everything associated with that property is 27 and a half year, 39-year property. But you don't know that when you first bought the property because why would the seller know? And why would you spend the money up front to get that done? So then we get into the to all beef pegs, extra sauce, lettuce, cheese, pickles, onions, and the sesame seed bun. Yeah, Gene, you knew the song, Gene. You don't gotta stay quiet on me. But this is what the cost segregation study is doing. It's basically taking your Big Mac and breaking it up into multiple components. So that, hey, the cheese, pickles, and onions could be 5-year property. The lettuce could be 15-year property. That could be your fence. That could be your pool, your porch, your deck. Your 5-year property, your carpet, your LVP flooring. So it's really just an engineering report. And once again, depending on the size of the property, how many units, that's going to determine the cost factor associated with it. So as you're, or even as you're, or people, or some of you may be getting into apartment building syndications. And this is what they're going to be kind of selling you when they're trying to say, hey, we're going to have all these losses because we're going to get the report. This is what the report is doing. And helping out from that perspective there. So this is kind of a silly way for me for me to break it down and talk about Big Macs on random nights like this. Um, but to actually like put real numbers into it. So this is a property that we sold, I think, yeah, 2020, well 2023. So it wasn't 100% bonus, but if it was, um, this is what their buyers' potential tax savings would have been compared to if they would have just done regular straight line depreciation. Once again, it's just a year one tax benefit, but that could be a huge help if you have other passive income that you need to offset, or you do, or your spouse may qualify for a real estate professional, so you're able to use those losses to offset your other portfolio income or your W-2 income, and reduce your tax liability that way as well. So this is what the 100% bonus um, renewal in the law is kind of allowing us to get back when we were doing back in between 2017 and 2022. So you'll see a lot of, like I said, mostly say a lot of apartment syndicators. You may see a lot of oil gas funds kind of try to pull people into this because they can offer this tax deduction that not many other investment opportunities would be able to do at this point. Questions on this or the Big Mac analogy? Either one's fine.
I like the Big Mac. I like the Big Mac analogy. I think everything you can combine with food is always great, right? So
Yeah,
probably I have seen that the second time now, and probably I will remember it the next time, right?
yeah. I didn't get this big for no reason. So free in my day. So fourth, what I'm gonna cover with the state law, and I'm not sure where everybody's from. If everyone's in a state with high state income taxes and stuff. So what ended up happening, Jim must be in Florida or Texas. So what happened in 2017 to help balance out the Tax Cuts and Jobs Act, is that they put a cap on the state and local tax deductions, which is an itemized deduction on your Schedule A of your personal tax return. They capped it at $10,000. So at states where like, hey, like just your state withholdings could have been over $10,000, you couldn't claim all of that on your personal tax return. You had to do creative strategies of setting up different businesses and having the prepaid taxes to your business in order to take claim that deduction. So, and once again, it's itemized deduction. What this new tax law is doing is increasing it from 10,000 to 40,000. But there was a lot of pushback from lobbyists in states like California and New York, basically your high tax states, saying like, hey, you're hurting our hurting our citizens with this cap. So they increase it so it does provide some relief for those who are able to itemize. If you're not itemizing because you don't got enough medical expenses or not high enough mortgage interest for your home or charitable donations, it would not apply to you. Um, but it is temporary. So this is through 2029 and it drops back down to 10. So a huge opportunity to kind of maximize that while it's here, as well as kind of lobby your state officials to put more pressure back on the government to keep it in place there. There are income phase outs associated with it, and so we don't go through all the weeds right now, but just kind of make sure you can qualify for that. But like I said, there is a workaround. Even if you're above $40,000, there is a workaround where it's called a pass through entity structure where you have a separate business, whether it's a partnership or S corp. You prepay your state taxes through that from your business, and then you get the deduction on your business side and reduce your taxable income there without having to worry about the cap on your personal tax return. It's still, like I said, for me, I know people are kind of happy about that, but it's like for me, it's still an aspect of prepaying taxes. Like I find that's kind of one of the last strategies we want to be doing. I want to avoid paying any government taxes and then bring in this stuff if they're going to cap your income that way, because you don't want to be taxed by the federal and the state on the same income, unrightfully so. Questions on this? Yeah, we kind of went through all the real sexy stuff, so it's going downhill from here.
Oh, it's going downhill. Oh my God.
I gotta be honest. Like I said,
Oh,
we started at the mountaintop with the fun stuff, because those things. And I tell people, like, when it comes to tax strategies, other than the top five I mentioned earlier, if I had to make a top 10, number six would be you're probably gonna have 3 to 5 machetes and 100 steak knives, because it's like you're only gonna have but certain things gonna make those huge slashes that we're looking for, but you're compiling all the small stuff along the way as well, in order to get the cumulative effect of a huge deduction. So it's like, and that's kind of how the code has been. Was like, yeah, if we can get a lot done with 2, 3, 4 strategies, but then let's stockpile some other stuff as well. And this is the state and local tax workaround I was talking about with the pass-through entity. Just kind of know whether your state allows it, and because everyone got certain regulations and deadlines, but it has to be paid and filed. If you're just a single member LLC, it does not apply. It does not apply for corporate C corps either. So you're really talking about partnerships, S corps, or LLCs taxed as S corps, filing a 1120S a tax return. As I mentioned before, it's a prepayment of state taxes, and then it's allow you to kind of bypass the if you know you're paying more than $40,000 in state taxes, then it's like, hey, that's your opportunity to kind of get the deduction that way through your business.
I have a question for you.
Mm-hmm.
When I think when you file as an LLC as an S corp, can you just do that for one of the LLCs you own?
Yes. So you want to make sure you're doing for an LLC that you're generating ordinary income for. You don't want to do it for an LLC that you're holding your land investments or your rental properties, anything that you're holding tangible properties in. You really don't want to do that for anything that's going to be you want to hold that in an LLC that's going to be an S corp. So whether
Mhm.
you're running a flipping business to help reduce the self-employment taxes, because that's the purpose of the S corp itself, is to mitigate that from, instead of that 15.3% FICA taxes hitting your full bottom line, it's only hitting the reasonable salary that you're paying yourself. But you, like I say,
Can you repeat that for dumb German people that they understand that too?
so yeah, so the purpose of the S corp election for an LLC is to reduce self-employment taxes.
Yeah.
Uh, Rental income, interest income, are not subject to that tax.
Mhm.
So having your LLC that holds those type of assets elect to be an S corp has done nothing for you, but really create more headache for me from a tax planning, state tax planning perspective. Um,
Yeah.
Especially if you have properties or assets that's going to appreciate in value, and you want to pass that down to children. Now they don't benefit for the step up basis, and then they only get the value of the asset, the book value of the assets. But you really want them to have the fair market value at the time that you pass away. But you break that by putting an S corp. So that's a separate LLC. Your LLC from your flipping business, or you're running a attorney, or you're a tax business, or you're a doctor. Like, that's going to be what's going to be your LLC tax as an S corp, because that type of income is subject to FICA taxes or self-employment taxes, and you want to make sure your bottom line isn't hit with that. That's the salary that you're paying.
So when you have like, I mean, okay, there's some passive assets, and when you would have like a holding company that holds multiple companies that are doing active business, um, how would that be structured then? What would make sense? Can you have the holding entity of the
Yeah.
active businesses having
Yep. So you
being
so
an
you, so
S
you have the
corp?
holding. Yep. So you have the holding entity as your one S corp, and then there's a risk tolerance associated with that, especially if they're similar businesses, or they maybe differ. But all the activity from a tax return perspective is going to flow up to the holding
Yeah.
company. Everything's going to be consolidated, reported there. Now everything's going to still
Okay.
have its own bank account and financials to
Of course.
protect your corporate veil. But from a tax filing perspective, there's going to be a consolidated tax return there.
Yeah. Okay. Understood. Sorry for interrupting that. It was just like a thought I had right now.
No, no. Great, great.
Let's go ahead like with the boring stuff, right?
um, the qualified opportunity zone. I'm not sure if anyone was involved with that. So really, the country has identified certain areas of blight, and I see qualified opportunity zones basically as 1031 on steroids. Because instead of it being a like kind exchange, it's just hey, you can just take any capital gain and roll that into a opportunity zone that you can pretty much have to reinvest just as much funds as the acquisition of the asset itself. So they basically create a separate like some new requirements associated with it. Well, that's my comment about the 1031. But you really have to have a fund in place already. A lot of people were just kind of buying in opportunity zones and then trying to put it into a QOZ fund, whereas you have to have the QOZ fund now and then buy the property itself, roll the gains into the fund, just like a 1031 exchange. You have a timeline of having that set up, you're and then you can buy in those blighted areas from there. Oops. Um, Yeah, so yeah, the old QZ funds taking the, like I said, so it could be your stocks, it could be from your real estate, it could be capital gains from your notes. So you're able to take various gains and don't have to worry about doing like kind of exchanges. It's just that with um uh QZ funds, it's the costly part is like, hey, if you spent whatever $250,000 to actually acquire it, in order to revitalize that area, it may cost you another $250,000. So it does require a significant amount of improvements needed in order to rebuild that area that you bought into, or rebuild that property that you bought in that blighted area. So they also add some additional reporting requirements that wasn't part of with the 2017 tax changes. So they basically have kind of learned their lessons from these first 6 years of having the QZ laws in place, and it's trying to kind of help put some more parameters about it to ensure people are doing it correctly. So definitely a huge opportunity if you are looking to sell stuff and reinvest it in a huge way, or do some if you want to get into that space of heavy renovations or into blighted areas. So that's the incentive there. Whereas let's get into the benefits. So you have, like say, you have a 5-year deferral on the capital gains itself. And then like you're able to then get a 10% discount, um, depending on the type of area that you're in. It could be up to 30% if the funds are held in there during the whole 5-year period. And then if you hold your funds in there for a decade, then there's no capital gains. So that's what the government was like, hey, like we're willing to not tax you on any capital gains. You don't have to worry about depreciation recapture if your funds stay into this in this area and help revitalizing into the if you're not selling and getting out and just keep reinvesting into the area as you are rebuilding and generating cash flow from there. So huge benefits is just a huge time commitment, or uh, cost of capital commitment as well. Of like, hey, you got a significant amount of money you got to commit, and you got to commit it for a very long time. So is that part of your investing strategy? Let's say once again, it's a discussion you and your family and your financial advisor has to have, as well as your CPA and your attorney, to know like, hey, does this make sense from a short-term and long-term perspective? Questions on QZ funds? Cool. Um, I put the no tax on tips and overtime up here because it got a lot of oh, I'm just saying bad. So not a huge impact for the people on this call. I'm not sure if everyone's kind of like what they do for their jobs per se. Um, but like I say, unless like you're not getting tips for being a land buyer, like, or if you are an hourly employee for your own business, like I say, you're not really going to qualify for it. So it's just really something to kind of keep in mind because I know what's going to happen with TikTok. It's like TikTok is trying to tell people how to really take advantage of it, and it's really just come easy pickings for the IRS to audit people at that point. So unless you're like in the restaurant industry, like Uber, like anything that's customary to receiving tips or being paid overtime, just be cautious of the scams and people trying to oversell you these quote unquote unique strategies to take advantage of. Hey, I'm gonna save another $25,000, or I'm gonna turn my proceeds instead of saying like it's a proceeds. Actually, I'm gonna take $1 and have them tip me $25,000. Like it's not gonna work that way. So their goal was to get certain voters that typically don't vote uh, in that space, and they got the votes needed to get Trump in office. So they're going to take advantage of it while they can, and it's lasts for the next 3 years. Now, obviously, there's some income phase outs as well. Once again, not sure everyone's particular income status on this call, but that's probably going to create some issues for you as well. Um, the car loan interest deduction up to the 10K annually, once again temporary, but I think what needs to be reminded is that is the car has to be new and assembled in the USA starting in 2025. So sometimes that deflates the room because a lot of people don't like US made cars, but the goal was to give a shot in the arm to the US auto industry, which it will. But everyone up here, just keep in mind, like this is the car has to be solely for personal use. So you lose the deduction if you're using for business. However, in my perspective, you'll get a better deduction anyway if you're having a business vehicle. Because you're able to write off some of the interest through your business, as well as depending on if you're depreciating the car and writing off the mileage, depending on which strategy you're doing, whether actual mileage or actual costs. So in my opinion, you'll get a higher deduction with business vehicles, but just know if you're not using a vehicle for business and you want to use a strategy, it has to be 100% um for personal use. And then if as I know a lot of the EV credits are starting to phase out towards the end of this month. So if you were looking to buy a electric vehicle and get the $7,500 tax credit, you basically got 2 weeks to do that before that goes away. But just kind of like I say, yeah, just want to kind of share on the car insurance deduction, how that the new law is kind of impacting people there. Questions on this? Nope. Cool.
So the car loan deduction is just for personal usage, right?
Yes.
Okay, interesting.
So I have a question.
Oh, go
Hi,
ahead.
Larry. A couple questions.
Mhm.
So if I have recently I had a really nice SS Camaro with Corvette engine blew, so I got to rebuild it. And in the meantime, I'm kind of I've got another car. It's a Subaru. It's on loan, and I'm leasing it from a family member. Is that deductible?
So it would require your family member to report the interest that they are receiving. So you can make it deductible, but it has to be like, hey, who received the interest? And now that
Yeah,
family
the
member,
car's paid for. It would be just my company would be leasing from that individual.
well, if it's for your company, then I'll just treat it as a business vehicle and then write off the lease payments if you're doing actual costs with your with that vehicle. Because it's not like
Okay.
you, it's not, yeah, because it's not like it's not really a loan per se. Like, hey, you're like a 5 year lease or something until your vehicle's back up and running. So you had to like lease the vehicle for a short period of time, but you really didn't buy it from them and have a loan with them.
Yeah, right. Well, I might have it for a year. 6 months to a year, a
Yeah.
while.
Yeah, so that aspect of like, hey, and then really you're just really tracking your mileage and because if you're using it for business and personal, only the business part, only the business percentage is gonna of the lease payment's gonna be deductible.
Okay. Well, part of it is I live part-time in the U.S. Virgin Islands,
Mm-hmm.
and my company is based here in Florida. My family's based here in Florida. I was considering shipping that car down there
Mm-hmm.
and keeping it down there for a year or so, maybe two. Who knows? The other question I have, so I guess that would just basically look like a business expense, I think, right? And that would
Yeah.
be deductible. And plus the freight and the shipping to send it down there. And
Yeah.
okay. Now, second question. I have an entity registered in LLC here in the state of Florida.
Mm-hmm.
I am kind of restructuring my business right now, and it has had some bigger transactions in the past. There's still some tax things that are owed and so forth. I haven't really done much to build any business credit with it yet. My question is, it's a standalone LLC, and I'm more of a fan of a structure like first in line, first in time. You got a holding company that's your trust or a personal interest foundation or any one of those or another LLC, and then the operational business um, would also that would be basically where we're doing business. So that would be so my company, American Land Solutions. That's my company. Um, so could I open that either trust or holding company? And let's say I wanted to open an operational company through the U.S. Virgin Islands. And
Mm-hmm.
then I wanted to take all the intellectual property from my current company and just kind of move it over, like the branding, like it would just by itself. And then I could either effectively deal with whatever personally through if I have any tax liabilities through the old LLC and to resolve that as I can. And then in the meantime, I'm operating efficiently and protecting my assets and cash flow with the new entity. Because you have to do it before to be first in line, first in time. So I'd have to reset and go with holding, whether it's a domestic company here, and then reopen. Let's just say I could just reopen the same business, but in the name, but file it under the USVI territory. So what do you think?
Yeah. Well, the part that you have to be mindful of is what's considered your bona fide residency. Whereas like, hey, it's not really based on where the business is because you are eventually going to be receiving money from that business unless the money just stays there and you're not really receiving any of it. So it's like, hey, it was like what, 150 or 180 days or something. Where it's like, okay, are you a bona fide resident of that territory in order to take advantage of the tax benefits of being there?
I had a lease on a property
Mhm.
that I was going to basically write that off as a corporate Benny, and so I leased a property back in a, May 1st kind of thing. So it was
Mhm.
like May. So yeah, it would have been, it was kind of a short-term lease that was month to month. I had a family tragedy. I had to come home, but I still have my lease agreement and I still have the relationship with them. So if I go back, let's just say I came home for a personal emergency. If I go back and then I can submit that, then I'll have bona fide residency. I was trying to get an ID card before I left. I had to come home and I wasn't able to do it. But
And and also when you say your family's in Florida, you're talking about your immediate family or just you just have family like cousins and aunts and your
no, well, my mom and that, brothers,
like
well,
I guess I'm talking about like so you have dependents that like wife and kids.
no, I'm not
Okay,
married. I'm
okay,
single. I'm single
okay,
though. I come home to take care of family here, take care of family states and stuff, and
yeah,
then I go back
okay.
and I live down there.
Okay, so then you're in the bed because they take that into account of like yeah your family, but like, that actual immediate family that you live with, um, like you being there and them being here is not going to make sense. So it's like the fact that it's just you like, yeah, you have the opportunity to recreate that entity in the territory, because you really have that you can prove that as your bona fide residency there, and get that set up that way. So yeah, I'll definitely make sure you kind of get that aligned, all the legal documents with your attorney and stuff like that to get that rolling.
Okay. So anyway, that's a good strategy, I guess, because I could just transfer everything that I branded here in Florida, just sell it to that company, and then anything that I had going on prior, well, I can work that out separately without any business interruptions. Is
Yeah,
that
yeah, because
true?
that's like I say, it's always the residency part that's always the tricky piece of it. And but if you have that part covered, then yeah, it's like, okay, how do you get everything transferred over that's not creating a taxable event in the US, especially you say you would try to sell it. So it's like, okay, how can we just get this transferred over, or just restart per se, especially from an aspect of I'm not sure what if you got any assets or anything in the business. So like I said, there's
No assets. It's just intellectual property at this point. So
gotcha. Yeah, I mean, so there's definitely a solid strategy. It's just that strategy is really more quirky for people who have kids and stuff, and can you basically uprooting
they
everything.
got a mortgage, they got kids, they got, yeah.
Like you already are there. It's like you don't have, like I said, that additional not liability, that responsibilities, that would kind of make it more of a hurdle for you to implement that. But yeah, so it's definitely something is worth pursuing and looking further into.
Okay. And other income taxes are different there too, a little bit. So there's maybe some other advantages, but it's still US based. And being a US land company, want to stay US based. What kind of holding company would you think would be better for that structure?
They typically just keeping it straightforward, a simple LLC, to get everything set up, and not knowing your numbers. And then as the business grows, okay, then you want to look into, okay, do you want to shift into a corporate structure there? But typically, especially going into territories, just keeping it simple, LLC, from a tax perspective, for the time being.
Well, I just look at it from liability because anybody that ever tried to go after any personal assets, the company would be in debt to the holding company, essentially. But you have to set that up first before, if you just started with an LLC, you can't set up the holding company because unless you bought a shell company that's older and flipped it, right?
Yeah, like I say, man, getting more into that's more the legal aspect of it now, and I'm not an attorney, so I'll definitely
Hmm.
make sure you run that by your attorney to make sure you're covered there.
Okay. I just wanted to get your feedback.
Man,
I'm just
I mean,
recent.
it's all like I said. I just want to say anything. It was like, man, this CPA is like, well, that CPA is not an attorney, so. But like I said, I've seen people like done that. It's just I just know that they have worked closely with their attorneys to make sure all the legal documents in place to get everything transferred over. So they're now operating out of the territory, and then they can take advantage of the tax benefits of living and operating from there.
Okay. Well, thank you very much.
Oh, appreciate it. Thank you.
Hmm.
Larry, we're almost over the top of the hour, 7 minutes. Let's wrap this up. I mean, like
Oh,
you,
I think we got the meat and potatoes and a couple of sides associated with it. This is all
Food.
desserts now. Everyone up here looks pretty young, so the senior deduction um, may not apply to most people on this call. But that's just like it's a 6K separate from out of my deduction, so a good benefit there. Um, but I'm just real big of this. Hey, thank you all for the opportunity, uh, and for allowing me to go over on time. But just kind of know like, hey, this is a team sport. No one's doing this by themselves. I'm grateful to kind of help and serve the way I can. So. Um, I appreciate everybody staying a week.
what I would recommend is I know that a lot of people have struggled with their taxes. Like, go over, schedule an appointment with Larry. Larry, can you just we have your link here in the chat, right? Can we make sure that his link is shared after this also on social media? Because I think, like working with Larry is like he's so clear on things and cuts all the bullshit and doesn't give you that what you don't need, but he gives you that what's possible and you need. So I really appreciate you for being on again. and enlightening us with that what you do. And I think it's something nobody of us can avoid. So grab the opportunity, connect with Larry. And I thank you guys for showing up. We had a bunch of people here. Thank you guys for being here on social media with us. And yeah, hope to see everybody soon. And yeah, next week we're gonna reveal something really cool on this call. So you probably want to be here because when you want to know how land marketing services on demand work, then you want to be here next week. With that said, have a great day. Thank you for showing up, and talk to all you guys soon.